a beautiful day here in Des Moines. We got a good view out of our window as normal. Lots of planes, lots of clouds, lots of billboards,
Lots of cars.
lots of cars. Yes, Fluor Drive. All right. Got 11 o'clock. Plenty of folks joining us today. Thank you so much for joining us today on our second quarter mid-year insights. We like to, all right, Lisa says we're good as far as everybody coming through. So thank you for that. Yeah, so we like to check in middle of the year and just kind of talk about where we've been, what's happening, where we sit now as far as the economy, and then we just had a big tax bill get passed that we're going to be discussing as well. So I'll kind of cover where we've been so far this year. Turn it over to Will to talk a little bit about the status quo, where we are now, some of the dynamics in the economy that we need to be thinking about. And then to finish up, I'm going to go through the provisions of the bill that I think are going to most apply to all of you as our clients. And so a lot of things have changed this year, of course, and lots of things to come. It's just the joy of living in America in 2025. And so, as most of you can remember pretty well, in April we had quite an interruption when the tariff incident or Liberation Day was announced. We had big volatility in the markets. The both interest rate and stock markets went nutty, quite honestly. We had plus 1,000 point drops on the Dow, caused a lot of folks to just be really concerned because it seemed like it was very policy driven. It seemed like it was, where was the end going to be? It was just kind of a tough time to understand the tea leaves. And we felt like it was one of those times when it just, let's wait and see, let's be patient, let the markets sort this thing out. And sure enough, they did. Once, one of the things that I did learn through all this is that if a policy error is made, policy can be reversed. And so winding some of those things back, delaying tariffs, all that had an effect of the market saying, okay, maybe we're okay after all. And so part of what Will's comments will be today is kind of where we're at with unemployment and some of those kind of things. But what we've seen is just a relatively stable environment after April that's brought the markets back into a little bit more friendly ecosystem, of course, and market returns have been better than we expected. And a lot of the folks that we study and got ready for on this call are pretty bullish or pretty positive for how the rest of this year is going to go. So let me pop up some slides for you and we'll talk about kind of where we're at and where we think we might be going from here. So, all right, we're just going to call this thing the bill. So rather than all the dynamics that go with it, because I read somewhere, Will, that beauty's in the eye of the beholder. And so maybe not everybody thinks the bill is beautiful. Some people do, but again, we never do politics here at Prairie Fire. We are just here to disseminate the information and sort the tea leaves as best we can for everybody. So here's our disclosures. And all right, I'm going to turn it over to Will. We're going to do a little back and forth here on kind of where we're at on the economy right now, the markets, and where we might be going from here. So what do you think, Will?
Yep. So let's start with unemployment and what this chart is showing. If you look on the far right, that's where current unemployment sits as well as wage growth. And you can see right around 4%. And last week, the jobs report came out adding 147,000 jobs in June, which was a little surprising. So far this year, it's been all negative in the news with all the federal job cuts, and you hear about layoffs around Des Moines, Wells Fargo, John Deere, etc. So here in the 147,000 jobs was a little surprising, but you can see the unemployment rate is quite low compared to the average. On average, it's about 6%. We're chilling at 4%, and then wage growth is also right about average. So what this tells me is, anyone who wants a job can still get one. And when people are working, they're spending money. And, the backbone of the economy is a spending consumer. So while consumers are still spending, I think the economy is going to be chugging right along as far as unemployment is concerned.
Are you considered part of Gen Z or are you Gen Y?
I'm Gen Z.
Gen Z. All right. So Gen Z says we're chilling at 4%. So I like that anomaly. Are you good there?
Yep.
All right.
Next is inflation. We've been hanging around the mid twos for a while. We've come down significantly since the peaks in 2022. And the main thing keeping inflation slightly elevated is shelter or housing costs. It's the dark blue at the bottom there. And that would just be, home prices are still a little high. Replacement costs are high for materials and labor, things like that. So, Matt, where do you think inflation will go in the next 12 to 18 months?
The chart kind of tells the story that we've hit a level that we're beginning to stabilize at. If you look back into the 2018s at the beginning of the chart, you can see kind of where inflation was throughout the whole inflation scare. As you can see, it was very malleable. Energy in the green was way up, then way down, and now it's below, but still there, and we see relatively low energy prices. But shelter has continued to remain persistent. Insurance costs, the ability to buy a home, furnish that home, it still remain relatively expensive. And food, it seems like, has had moments where bananas and eggs are expensive, and then moments where they're not. I think inflation is going to be a little more persistent than what we've had in the past. When we had zero interest rates, zero inflation, those were good times. And now we're more likely to see prices stay a little bit more elevated than what we're used to. And I also don't think that we're going to see huge changes in interest rates.
Next, we're going to move on to the dollar. This has been in the headlines in the news so far this year that the dollar is weak. It's declining. Well, yes, it is declining. I wouldn't call it weak by any means. If you look at the chart on the left, where that red line is, you can see where we are today is pretty average going all the way back to the 1970s. I mean, yeah, we've had huge spikes and some steep declines, but we started the year a little elevated. So you see year to date, it says down 11%, but we started high. So we just gave some of that back. But I think a couple of reasons for that would be the dollar supply. There's a lot of supply out there from COVID and things, and then the US's debt issue that seems to just be ignored by Washington. There's no appetite on either side to figure it out. And so I think investors are looking at the US as a less favorable creditor.
Yeah, the call I was on yesterday, Marianne Bartels and some others were talking about the dollar, and her view is that the dollar is still very strong, that if you consider it over a longer period of time, that's the case. We had a lot of money get printed during COVID. And so that money has to find its way into the system. And I think that's supply. And I think you agree is probably why we've had the dollar decline a little bit, but it's made our stuff cheaper. You're also got the tariff issue thrown into there. And so the intent is to have more production, more things made in the United States, all of that. I think all of that is impacting this dynamic with the dollar.
And then next is talking about, outside the US, international stocks have outperformed the US this year. And on the left, you can see earnings growth in countries like India and Japan are also outpacing the US. A few comments here would be, I think part of the reason why international stocks have done well this year is their valuation is pretty cheap compared to US stocks. US stocks are pretty expensive. So someone, buy low, sell high investors could find some opportunity over there. But Matt, I wanted to ask you, do you think the US exceptionalism is going to fade, or you think it's going to stick around?
I think we're still one of the, as far as the global economy goes, one of the strongest economic engines, as well as the way that we export our services and that. So I think the American exceptionalism could only have come down because it was so high after the last 10 years, where we've seen, the US really be a huge global economic leader. You can't stay there forever. It's cyclical. And so I think, whether it's and not in the political aspect of it, but in the economic aspect of it, we're still a very strong economic engine. And I still think it's going to be true if we get a cold, the world's going to get the flu. All that kind of dynamic is still going to play out. But as you're beginning to see is that earnings growth in other parts of the world have pretty good expectations to continue to grow. We've seen, as Will mentioned, international stocks do better than we've seen in a long, long time. I've been hearing the song for 15 years that international stocks have to do better because their valuations are so much lower. But we just haven't seen the earnings growth from those companies. And so they're not going to be rewarded with extra capital from the markets. Now you're beginning to see some of that change around as people are nearshoring, creating their own energy infrastructures, all those kind of things. So it only could pull the US back a little bit, but I don't think our role as an economic leader is going to change in the near term.
And I will say just one last thing, even though we've seen outperformance this year, we're not getting over our skis and overweighting client portfolios in international stocks by any means. We definitely want exposure, but we're not going to go all in on international.
Let's buy a bunch of Ecuador.
And then moving on to interest rates, I've been reading that there's still a possibility for, 2 rate cuts in 2025. We'll see. I'm not quite sure I'm completely sold on two, maybe one. But what we have seen is the Fed is kind of playing it safe, really waiting to see what the tariff impact will be. They've proven they're staying in their lane, staying independent, not, being influenced by the current administration. They're just doing what they're doing. But I would, if we do have two rate cuts this year, I would probably say they're going to be smaller rate cuts.
Yeah, as you all know, Powell's getting a lot of pressure from Trump as far as lowering rates. Trump's a real estate guy. He understands low interest rates and wants the economy to operate that. Yes, if you compare it to other economies, our rates appear to be high. I think the Fed's really interested in keeping some powder dry to lower rates if we have some economic collision of some sort down the road, like a recession. As long as the economy remains pretty firm, Will's first slide on unemployment, that's their other mandate, remains relatively muted. They're not going to be eager to use the bullets in their gun before they have to.
And the last
Tariffs, what are those?
the last slide I'll talk about is tariffs, and I'm sure everyone is sick of the word tariff. I know I am, but it goes all the way back to 1900. You can see they were quite elevated in World War One, and then picked back up again in World War Two, and have been on a steady decline since until now. The orange is the estimated average tariff rate after Liberation Day, and you can see in the blue it's come down dramatically as trade deals get worked out, negotiations continue. And we'll see what happens. That could continue to go down, could also continue to go up, which depends on who the administration gets in a tizzy with over the weekend. So
Yeah, you're beginning to see the market detach from this, I think, don't you, Will? Because we're seeing, announcements over the weekend or like copper 50% this morning or yesterday. And the market isn't really reacting to that as much as I think they're understanding this is a negotiating tool that's being used more so than, policy driven imperatives. It has to happen this way. And I think Secretary Pacent in particular is trying to work out deals behind the scenes. And so what we get after the wash, the press conferences, and the Twitter feed is a little bit more malleable or digestible by the markets, it seems such thing.
yeah.
Okay. All right, thanks, Will. We always have the chat open on this too, everyone, as well as Q&A. So if you have a question or you want to have us expound on anything further, please put it in the chat and we can address that as we go along here. So I'm going to talk about the new bill. And one of the messages that I wanted to send is that this is a continuation of current policy in a lot of cases versus a revolution of change. And so I'm not going to focus at all on where the money is going to be spent. I'm going to be focused on the policies that will impact all of you and your taxes and or your personal planning situations, because that's the area where we live and are here to help with everyone. So the standard deduction, since the standard deduction was raised with the original Tax Cuts and Jobs Act, there's been a 30% decline in the number of people that itemize in their markets, or excuse me, the number that we're itemizing is down to now 10% of the overall global populace, US population, that is now itemizing their taxes because that standard deduction is so large. And so the new level is going to stay the same, and then they increased it slightly as well. So for a married filing jointly couple, it's going to be $31,500 for this year, for 2025 tax year. And for a single filer, it's going to be $15,750. Then there's going to be some additional standard deductions, but I'm going to talk about that in the Social Security part. So some of that has changed as well. And that, as I'm understanding it, was made permanent, and those are going to be indexed for inflation. However, is anything permanent in Washington, Will?
No.
So for this administration, it's permanent, but to say that this is going to go on for the rest of our living lives is difficult to say, but the bill puts it in as a permanent change. So the standard deduction is going to remain high. For many of you, what that means then is that if we're looking at charitable deductions or those kind of things, we want to make sure that we're doing it in a way that's going to make the itemization of that more valuable than what the standard deduction is going to give us. So part of our planning has to include what that standard deduction is going to look like for you. We can run scenarios, as you know, in our tax planning software and those kind of things to see how much we would need to do on the charitable side or how much more you're going to get in state and local taxes now that that cap's been lifted up a little bit to deal with that. So that's, as far as the standard deduction goes, how that's going to work now. They made the child tax credit permanent and moved it, I believe it was 2,000 up to 2,200. The estate tax was going to sunset to $7 million a person, which is at $13 million right now. That's going to be made permanent at 2026 in 2026 at 15 million a person, so 30 million a couple. So a massive deduction there. So farmers in Iowa that have a lot of appreciated property and farms, wealthy business people, those kind of folks are going to be pleased with this. Also makes it permanent, but I've seen this change, I don't know, 10 times in my career. I don't believe it will stay permanent. I think this will be something that's always a political volleyball back and forth, depending on who's in office. Capital gains rates, contribution limits to IRAs, all of those kind of things have not changed. Every year they usually add $500. They had to make a few changes to catch up contributions. Capital gain rates at 15% and then up to 23.8, depending on your income bracket, are staying the same. Once again, I think this is a political volleyball that could move around in the future, but right now, as we're planning over the next 3 years at least, they're going to look pretty much the same. So one big change was the state and local tax. And so right now, if you are itemizing, you're allowed to take $10,000 per year off your taxes for your state tax that you pay and in local taxes, depending on what city that you live in here in Iowa or wherever you're at. That's going to move up to 40,000. And that's only applicable if you make less than $500,000. This is one of the caveats that will expire in 2029. So in a few years, we'll be hearing about this again. This was basically applying to high tax states like New York and California. And I believe the senators from those states were really pushing to get this lifted or at least raised. And this is where they landed on it. So for those of you that are paying quite a bit more in state taxes, you'll get some relief here up to that 40,000 number. Once again, if you're making less than 500. If you're making over 500, it begins to phase out over a certain number of brackets. And that's, again, something that we can look at for everybody. Okay, so if you got today's email, I talked a lot about some of the charitable changes. And that's going to change a little bit whether you itemize or whether you take that standard deduction. But if you're a non-itemizer, which means you're taking that standard deduction, which a lot of you on this call that does fit, you're going to get a $1,000 deduction if you make a cash contribution to a charity in 2025 and going forward. So those small contributions that you're making or the little, you want to make sure you're keeping your receipts on those because this year you will get some relief on that, where in the past it didn't do a whole lot of good for your taxes. So now that we're in July 10th, it's even if you've made some contributions year to date, you want to be keeping track of those so that you can get that $1,000 deduction. They then change the way it's going to work if you do itemize to be a part of your income. You can kind of think of it like this. This is like the medical deduction where they require it has to be a certain percentage of your income before you qualify to deduct that. Same thing's going to go on here up to a 0.5% of your adjusted gross income floor. It has to be. So if, for instance, you make $400,000, you'll need to give at least $2,000 before you can deduct anything. And this will apply even if we're doing securities contributions. The things that I always encourage everyone to do is use appreciated securities instead of cash. We're going to want to watch this floor to make sure that we're doing enough to once again get the advantage of that and that itemization is going to be the right thing for you. We'll partner with all of your CPAs and tax people on these things. This is just guidance as we're helping you with the charitable discussion and how that's going to work. They made a few changes to the reporting requirements for donor advised funds. I don't think these are a big deal from what I can see. I think the donor advised fund, which we're a huge fan of, remains pretty much the same. It's if you're donating art or if you're donating a farm, real estate, illiquid investments, things like that, where I think there's going to be some additional reporting to take the justification. They're trying to prevent fraud and big contributions made to these funds. But we still love that donor advised fund framework where you can put money in and then make the gifting whatever you want down the road. And then if you're using qualified charitable distributions from your IRA, the QCDs, for those of you that are over 70 and a half, there's been no change there as we understand it. So we should be able to continue to use those as we have in the past and bring those taxes down and still benefit your charities. This has been a great tool for our clients and one that we'll continue to help you with. And then it may be that we want to start talking about bunching your donations. So if you're planning to make a number of contributions to a certain institution, we should model whether we want to do a bunch of those in one given tax year like this year, and then to get the most credit that you can from these new rules. Okay, so you heard a lot about no taxes on Social Security. That's not the way this thing played out. It's going to be now, if you're over 65, you're going to get a standard deduction increase of $6,000. Depending on your income. This $6,000 will apply up to $150,000 in income for a couple and $75,000 for an individual. So this is going to play out differently for all of you. And once again, something that we'll need to help you model to see how this is going to work. So it isn't really a Social Security deduction at all. It's just a tax deduction based on your age that'll apply to your total income. So they really window dress this one to say it's really helping the Social Security crowd. And it is, because a lot of people over 65 are taking Social Security, but it's not going to apply directly to that tax. It's your overall tax situation. And that's why it's important that we spend a little time on this with everybody to see how that's going to impact you and if it's and what the benefit's going to be. So it's a good thing. I'm not saying it's a bad thing for those of you that are collecting Social Security. I'm just saying don't expect it to directly impact your Social Security. The other thing is, as you know, if your income increases, you can be subject to higher Medicare premiums, that IRMA premium. And so I didn't see anything in the bill that impacted that at all. So I think as the income changes, the standard deductions, we want to keep all of that in view as a holistic solution to what income is going to look like based on these changes here. But yeah, $6,000 deduction if you're over age 65. There's a few other things, like they continue to expand the eligibility for 529 distributions. So you can use it more for K through 12 private schools, trade schools, are really trying to expand so that people don't use these in a lot of cases because they're concerned their kid isn't going to go to school. Well, there's so many ways now to use these, from later in life. Will's been doing this with a lot of clients, helping them convert old money that they had in 529s to Roth IRAs for their kids, using it for 1-year trade schools, beauty schools, whatever your kid may do in this wide world of educational bounty. And I tell you what, if you want to, I wish we had a chart just on inflation for college, because that's not going anywhere. That continues to just go up, up, and up, no matter where you're going to school. Even local community schools, we're seeing those prices go up. You see that new proposal from UNI where they're going to give,
To all the bordering states,
yeah,
you get like in-state tuition.
right.
Yeah.
Yeah. Go Panthers. So I saw a guy on Twitter like, I paid 3 years and I live in Illinois. I'm ready to get my money back. And no, you're not, brother. Sorry, but get a chance now to get that. And then there's when you make an auto purchase, there's going to be some sort of tax credits, but it depends on the vehicle and those kind of things. So I think a lot of that is still fluid. Some of this, it all comes out in the wash, as in most things in Washington. So we don't know everything that's going to happen from here, but we've got a pretty good idea on some of this stuff. And it does give us a lot of good planning opportunities. So as we're doing your reviews and check-in calls throughout the rest of this year, taxes and how the new bill is going to impact your personal situation will be front and center. I want to make sure that we're talking about that. So if you got a question here in the chat. It was more of a comment. So, all right. If there are any questions, thank you for the comment that were funny. Will and I have a pretty good time in here. Every now and then we rope Lisa into our little discussions about life in general and the joys of economic realities, things that we think are funny that probably nobody else does. But anyway, yeah. So, Will, what do you think? Where do you kind of think we go from here for the rest of the year? And not just that we don't make predictions, as you know, but if you looked at the overall landscape, good, bad, otherwise, what do you think?
Think, how things are set up now, I think we could be in store for a decent year. And I guess like we saw in April, things could derail quite quickly. But as it sits today, I think we're gonna be okay. I think we rode out the wildness of the second quarter, and hopefully we can finish the year strong. But one comment I did want to make with the bill about student loans, there's been some changes there. I think for people who are holding on hopes of student loan forgiveness, I think that's probably pretty much out the window. And then they reduced the number of repayment plans. Now there's going to be two different ones. There's going to be a standard repayment plan, which is a fixed payment over, I believe, 10 years. And then there's one called repayment assistance plan, or RAP, and that's going to be based off of your discretionary income, how many dependents you have, etc. And I think those payments can be variable depending on those factors. And it didn't give me a time frame or a payment schedule, but I would guess anywhere from 10 to 30 years on that.
Okay. Yeah, I think the other thing just to be aware of, and why we diversify, why we believe so much in being ready for a range of outcomes, is just the geopolitical climate is not the same. There are, wars going on. There are threats of wars in other areas. There is weaponization, lots of political angst in every country, not just ours. And so I think all of that could lead to some volatility. And when the markets are high, when prices are stretched a little bit as they are now, you can, see some pretty quick snapbacks like we saw in April. But like in April, we also, we don't know when that's going to turn around, and trying to guess the ins and outs of that would have been impossible, in my opinion, in April. Trying to figure out, well, what's going to happen this weekend? Should we get back in, get back out? It doesn't work. And if you're good at it, you're the only investor I've ever met that is. And so we just try to apply these principles. I know people get tired of me saying it, but it works. And we believe in keeping our clients safe and keeping our clients not taking those big losses when they come along so that we can recover as quickly as possible and, get you ready for retirement, keep you retired, help you with your kids and all that kind of fun stuff, the things that we love to do here. And so while we think we're in pretty good framework right now, I saw a quote here as far as should we be worried about a recession? And this guy said the combination of stable employment, moderating inflation, trade-driven GDP contraction likely reflects an economy in transition, not crisis. And I would agree with that. I think we're relatively stable at the moment. Things are changing. Tariffs are going to change things. Onshoring, nearshoring, deglobalization is a trend that's going to continue and only plays into that theme of infrastructure that I so believe in. I also think bonds are starting to look a little bit more attractive, where they're stabilizing a little bit as far as their prices go. If rates do come down a little bit, that's obviously positive for bonds. It's not obvious. They work in an inverse way, but so there's always opportunity. There's always things going on. There are parts of the world that are really beginning to expand. We've, taken a deeper dive into a country like Mexico that could benefit a lot from nearshoring, where we're outsourcing some of our labor there because it's closer to us, so we don't have all the supply chain concerns that we have when we have to buy medicine from China, for instance. All of those dynamics play into our investment process and theme. Will and I had a good investment committee meeting yesterday, just talked about the landscape of things and feel real good about where we have our portfolios positioned right now. So, all right, do we have any other questions in there that we see? I don't think so. All of you know how to get a hold of us. We are at our desks working hard, even though it's July 10th. I'm not willing to admit that summer's halfway over. I don't really think it really starts to wind down until the state fair. And then you still have at least a month or two. And of course, it's relative to how often you can play tennis outdoors and whether the golf courses are open and some of the fun stuff too. But more than anything, it's been an interesting year. We've really enjoyed spending all of it with you guys, and enjoyed. You probably saw some of the pictures on Facebook and stuff, but my son Matt got married a couple weeks ago, and that was very exciting family event that we had, and so appreciate all the kind words on that. But we are here if you need us, and we thank you all for joining us today, and we'll look forward to what's to come. Thank you.
Thanks, guys.